So in this video, we are going to go through a demonstration of how policy loans work. This is meant to be a simple example. Let's get on into it and have some fun. First, we'll explain it through a whiteboard, and then we will look at an actual illustration. So when it comes to policy loans, one of the most important things to do, in my opinion, is first see what your policy looks like if you pay money into it and just let it sit and grow. This provides the foundation, one, to make sure your policy is properly designed and set up for maximum cash value, but then two, you get to see the exact impact. What's the exact dollar amount, the internal rate of return, everything you can see. If I let it sit and grow, compared to taking loans, how much does it impact me negatively from a pure interest rate standpoint? Just to visualize that, a lot of people have liked that. So let's start with a growth example. If you've got a whole life insurance policy and today you have cash value of $100,000, and we'll assume you have a death benefit today of, let's say, $500,000. This is your actual death benefit. If you do nothing and just let it sit and grow, let's assume 10 years from now, your cash value is going to appreciate to $200,000. I'm just going to use a round number, no math involved, just keeping this very, very simple. And your death benefit will grow to, in this example, let's say $750,000. Okay, so this just provides a quick demonstration of what your policy looks like if you park money, let it sit and grow over time, and you know, okay, I've got access to this cash value anytime I want. This is great, a nice asset on the balance sheet, safe, liquid, tax-free. When I look at the loan scenario, so today, starting with the exact same policy, I had what in cash value? $100,000. Death benefit was what? $500,000. But this is before I take a policy loan. Now let's assume you're going to take a loan for half of the equity, half of the cash value you have. Whatever you have in cash value determines how much you can borrow against the policy. So for example, if I have $100,000 in cash value, I cannot borrow $150,000. Whatever my cash value is, that is the maximum dollar amount I can request in a loan. So if I decide to loan half of it, $50,000, there will be loan interest that goes to the insurance company. So let's say it's 5%. Again, it goes to the insurance company. It does not go back to my life insurance policy. I just want to make that very clear. There's some confusion around that sometimes where people are under the impression that any money they borrow, the loan interest is paid back to themselves. That is not the case. The loan interest goes to the company. Now, when I take that $50,000 loan, what happens here is remaining equity, additional cash value that I can still borrow, is $50,000. Simple math, I had $100,000, I took a $50,000 loan, I've got $50,000 in remaining equity. Now, the life insurance company, this is how loans work, will continue to pay you the same dividend interest rate on the full $100,000 as if you never touched it in the first place. So how do they do that? That's often the question that comes up. How they do that specifically is as follows. One, there is a cost to borrow. So in this particular example, 5% of $50,000 is what? $2,500 that the life insurance company received. That's in loan interest. And then here's the main thing. When we take a loan, you will find that the insurance company is going to collateralize your death benefit dollar for dollar. So if you take a $50,000 loan today on your online portal, you will see your life insurance death benefit updated to $450,000. Meaning if you die when that $50,000 loan is outstanding, that's the net death benefit that will be paid out to your beneficiaries. Whatever the total death benefit is, minus the loan balance. So the question was this: why would the insurance company continue to apply a dividend rate or a dividend to my entire cash value as if I never touched it in the first place? And the answer to that question is one, there is a cost to borrow, and then two, the death benefit's collateralized. So that's the main reason why, that's how they do it. Now, here's the beauty of it, and here's where a lot of people get attracted to it, is, let's assume for this example, you pay your loan in full at the 10th year or any time before. You could gradually pay it off in a lump sum, does not matter. What you will find is at the 10th year, your cash value will be $200,000. And your death benefit will be $750,000. Which, if you look at those figures and compare them to the example where you never touched the money, over here, you just let it sit and grow, do you see a difference? No, they are identical. So what happens here is you continue to receive dividends and interest. When I say dividends and interest, I'm talking about the dividend piece and also the guaranteed piece. You receive, call it earnings, from the insurance company on your entire cash value as if you never touched it in the first place. Now, you will see some differences depending on the insurance company you select. You could see some differences, I should say. And what that has to do with is if the insurance company is non-direct or direct recognition. We do have some video content on that goes through the exact differences. You see exact policies, what they look like when I loan and repay. But regardless if the company is direct or non-direct recognition, you will see, if it's one of the four major mutual companies, you will see them continue to apply dividends on your entire cash value, regardless if a loan's outstanding or not. Interesting stuff, right? Let's take a look at some numbers here. So what we're going to look at is a simple policy where we've got a 45-year-old individual. He is going to fund the policy with $100,000 per year for 5 years and then nothing thereafter. So we've got a simple funding schedule here, and we can make this 10 grand per year, but you'll see exactly where we're going. So first, we'll look at growth. Here's his 100K per year. First year, he pays in $100,000. He's got $84,000 in change, so this is juiced for high cash value. That's his first year cash value. We've got a level death benefit here, and we did this deliberately just to illustrate how loans work. Next year, pays in $100,000, 84 to 177. Then by the third year, pays in $100K. He gets his $100K back, plus another $2,000 in change on top of it, and the break-even point is year 5 in this particular example. So this example demonstrates or displays what the policy looks like if I just park money, let it sit and grow. Now I want to compare that with the exact same policy with loans coming out. So in this particular example, I took a loan out in year 6. We did it year 6 after the funding period just to make things clean. You can absolutely take out a loan while you are paying into the policy. But here, we took a $300,000 loan. Your cash value is, again, your equity, the gauge that determines how much you can borrow against the policy. So you took that $300,000 loan, and what went down here? Your cash value. So before loan, it was $500,000. After loan, it was just over $200,000. What else do you notice? Look at the example where we just parked it and let it sit and grow. In year 6, death benefits what? $1.55 million. What is it over here? $1.25 million. If you take that 1.5, subtract it by $300,000, what happens here? You get $1.25 million. The death benefit is collateralized dollar for dollar in this example. And you'll see this with just about any life insurance company, almost always be dollar for dollar, unless the insurance company is withholding the loan interest up front, then you'll see it the loan amount plus the loan interest, assuming you don't pay it. But here, $300,000 loan, we ran this at a loan interest rate of 5.65%. The actual loan rate with this product is lower than that, but we increased it deliberately just to show a more conservative loan interest rate. So it's at 5.65%. And what we did here, we've got the loan interest, just about $17,000. In this example, we paid the loan interest out of pocket, and then we also applied $30,000 toward the loan principal. Now we can pay it however we want, but in this example, loan interest comes due, we pay that, and then at the same time, we pay another $30,000 in loan principal. Why we did that? We took a $300,000 loan, $30,000 times 10 is $300K, takes us 10 years to pay off the loan in this example. Although meanwhile, we are paying the loan interest as well. So We could add another column. You'll see that in the video to follow this one, where we do add a loan interest column, which tallies up the total amount of loan interest you pay to the life insurance company. And this does assume a higher rate than where the rate's at right now. And again, that's just running things conservative. But here's what I want to hit on. When he's paying this loan down, what do you notice about your cash value and death benefit for that matter? Coming up. What about when that loan's paid in full? So let's look down here at age 62, year 17 in this example. Your cash value is what? $851,000. Your death benefit is what? $1.55 million. What is it in the example where you just let it sit and grow? Check that out. $851,000 and $1.55 million. So the reason why everything is 100% restored to exactly what it would have been as if you never touched it in the first place is because you continue to receive dividends and interest on your entire cash value. You still continue to receive a dividend as if you had this dollar amount in cash value, even though you had borrowed $300,000 in this example. Just as if this policy was a piece of real estate appreciating at, call it 4 to 4.5% over time, you can borrow against it, but if the fair market value goes up by 4 to 4.5%, you still receive that on the entire property value, not just the remaining equity. And this demonstrates one loan. We could take multiple loans. We can pay it back over a shorter period of time, longer period of time. In this example, this is a non-direct recognition example. When the loan is repaid, I see everything fully restored to what it would have been as if I never touched it in the first place. This is where people often feel they have no lost opportunity cost when they're taking out loans. The only thing we do have to account for, like what's the actual cost in this example, the loan interest. And depending on where rates are at, if I've got a 5 or 5.65% rate with an insurance product, what a lot of investors do that we work with, when I say investors, real estate investors is what I mean. They'll often take their policy to a bank or third-party lender, assign the cash value as collateral to that lender, and obtain a more attractive loan interest rate. Depends where interest rates are. That sometimes makes sense, that sometimes does not, but it is a nice option to be aware of. In any event, I hope that this video was helpful with respect to how policy loans work. If you're working with us, this is something we like to show to everyone we work with, particularly when looking at loan scenarios. And it's always based on what you want to see. If you don't know what you'd like to see, but you want to see some loan scenarios, we'll make up a couple different scenarios. But if you said, hey, I'm thinking about taking X amount of dollars out, and I'm going to use that for buying a car, investing in my business, I'm going to buy a piece of property, whatever it might be, what does it look like? Can you show me what it looks like if I take a loan, pay it back? But then can you also show me what it looks like if I take a loan and I don't pay it back? Does that negatively impact me? Well, we will look at that in the next video. So again, I hope you enjoyed this one. Let us know if you have any questions on it, and we'll talk to you soon. Thank you so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.